What's up, everybody? This is Sunko, the Korean bro. Today is 2023, um, June, July, August, September 19th. Let's begin. Okay? Hmm. Two solid dividend index funds are proven moneymakers to buy now and hold forever. Here's the scoop on the two IPO stock everyone's talking about right now. Four things about Opera Software smart investors know. New stock stalling, but the space stock is really throttling down. Is it too late to buy Atlassian stock? Mm, no. Two solid dividend index funds that are proven money makers to buy now and hold forever. Income investors looking to spend less time in portfolio management should prioritize dividend index funds over dividend stocks. The Vanguard High Dividend Yield ETF returned 152% over the last decade. It currently yields 3.2%. The Vanguard Dividend Appreciation ETF returned 182% over the last decade and now yields 1.83%. Holdings. Stock stays volatile. Shares of Holdings were down about 5% at the open on Tuesday morning. They followed up on a similar decline on Monday as investors try to find equilibrium following an impressive IPO last week from the semiconductor maker. Atlassian sales growth is stabilizing in a tough market, but it expects its gross and operating margins to decline in fiscal 2024. The stock still looks expensive related to its growth prospects. Atlassian stock has rallied nearly 60% this year. Investors turned bullish on the enterprise software company again as its revenue growth stabilized and its operating margins expanded. Let's review its business model, growth rates, and its valuations to see if it's too late to hop onto the bullish bandwagon. Its growth is stabilizing as its business model evolves. Atlassian was founded more than 2 decades ago in Australia. Its first two major products were Jira, which helps companies plan, track, and release software products, and Confluence, which allows employees to collaborate on documents. At the end of fiscal 2023, Atlassian served 260,000 262,337 customers across its cloud, enterprise, and IT service management platforms. That represented 8% growth from 242,623 customers at the end of fiscal 2022. The fourth quarter of fiscal 2023, it generated 60% of its revenue from its cloud platform. The rest came from its data center, server, and marketplace and services platforms. Here's how those four businesses fared over the past year in terms of revenue growth. Atlassian is currently migrating all of its server-based customers to its cloud and data center platforms and plans to pull all support for its server business in February 2024. That's why its server revenue is declining, and why I expect that figure to drop to zero by the fourth quarter of fiscal 2024. However, Atlassian's cloud-based business still suffered a slowdown over the past year as macro headwinds drove more companies to drain their spending. Its data centers even experienced a milder slowdown as they absorbed more of its server-based customers, while its smaller marketplace and services segment continued to grow as it expanded its marketplace for third-party apps and subscription-based support services. We've established that Amazon has lots of growth opportunities that can add to its already dominant position, but investors need to be mindful of the valuation they're being asked to pay. Despite the stock's 66% rise in 2023, shares trade at a reasonable price sales ratio of 2.7 right now. That's considerably cheaper than its trailing 5-year average, indicating that there is a deal for investors to take advantage of in the stock market. What a difference a year makes. Amazon side stock dropped 50% in 2022 thanks to rapidly rising interest rates and heightened fears about a recession crushing asset prices. This year, however, the top tech company handsomely rewarded investors. As of this writing, shares of Amazon are trading hands at about 140% and $140. This makes the tech giant a no-brainer FANG stock to buy right now for less than $150. Here's why that's the case. Multiple growth engines. Amazon's current market cap of $1.44 trillion dollars in trailing 12-month sales total of $538 billion dollars early easily makes this one of the largest corporations in the world. Naturally, investors would think that there isn't much growth potential left as we look over the next 5 to 10 years. And this could dissuade some from taking a closer look at the stock, as the prospective returns might be limited. The way of thinking is understandable, but I don't believe it applies to Amazon right now. The company still has lots of expansionary opportunities. Understanding its revenue drivers will provide more clarity. Of course, everyone knows Amazon to be undisputed leader of online shopping, as it has 38% share of all e-commerce activity in the US, according to Statista. The business basically spearheaded the secular trend of online shopping and now sells millions of items on its popular website. Data from the St. Louis Federal Reserve shows that even after its rise over the past couple of decades, online shopping only makes up 15.4% of all retail spending in this country. That means there is still a ton of room for Amazon to grow its presence when it comes to e-commerce. The company also owns and operates the world's leading cloud infrastructure and services providers, Amazon Web Services. Revenue in this segment increased 12% latest quarter, a notable slowdown from previous years, but still seizable. AWS is extremely profitable with an operating margin that typically exceeds 20% and should see tremendous growth as the industry is estimated to be worth $1.6 trillion dollars by the year 2030, compared to $600 billion this year. Investors might be unfamiliar with Amazon's success in digital advertising, a burgeoning business line that increased sales 22% to $10.7 billion in the most recent quarter. By running a website that had 3.2 billion visitors in the month of August, Amazon has one of the most popular internet properties out there. All this attention creates the perfect environment to sell digital ads, a market that will only get bigger over time. The one and only stock Warren Buffett loves even more than Apple. To timely growth stocks to buy now and hold forever. History says the S&P could climb about 6.8% by the end of 2023. As the second largest e-commerce company in US, Shopify should benefit as more wholesale and retail sales occur digitally. As the fastest cloud network and leader in zero trust security, Cloudflare should capitalize on ongoing investments in digital transformation. Shopify provides a turnkey solution for omni-channel commerce. Its software allows merchants to sell products across physical and digital stores, including popular marketplaces, social media networks, and direct-to-consumer web pages. The company also provides adjacent solutions for marketing, payments, and wholesale, as well as the logistics support through partners like Flexport and Amazon. Shopify is the second largest US e-commerce company behind Amazon, and it's the global leader in e-commerce and omnichannel commerce software. The strong market presence translated into solid results in the second quarter. Revenue climbed 31% to $1.7 billion, a meaningful acceleration from a 16% growth in the prior year period. And non-GAAP earnings per diluted share improved to $0.14, up from a loss of $0.03 per share. Turning to the future, the e-commerce software market is projected to increase 16% annually through 2030, while retail and wholesale e-commerce sales are forecast to grow 8% and 20% per year, respectively. Shopify is tackling those opportunities through product innovation efforts to push market. Cloudflare makes the internet faster and safer for clients while serving as an agnostic intermediary between vendors like Amazon Web Services and Microsoft Azure. The company powers about 20% of the internet. The ubiquity is a part of unparalleled speed. Cloudflare is the fastest cloud network on the market, and freemium pricing. It also provides companies with the insight into performance issues and security threats across the web. As a result, Cloudflare was recently recognized as a leader in email security and zero trust network access. The company has also been hailed as a leader in ads development platforms. Second quarter earnings saw its customer count increase 15% to 174,129. It clocked a dollar-based net retention rate of 115%, meaning the average customer spent 15% more than they did in a year ago period. In turn, revenue climbed 32% to $308 million, and non-GAAP earnings improved to $0.10 per diluted share. The beaten down stock is poised for a rebound. Despite the rally for the stock market this year, PayPal stock has tumbled roughly 12% across 2023's trading. The fintech share price is now down approximately 80% from the high they reached amid pandemic-driven engagement tailwind back in July 2021. Admittedly, it's not just the waning of pandemic-related demand and macroeconomic shifts that have tamed the company's valuation. PayPal has seen its pricing power erode as new competitors have entered the payment service space. Investors are also antsy about the departure of long-serving CEO Dan Schulman, who will be replaced by former Intuit executive Alex Chriss later this month. On the other hand, the PayPal's business remains highly profitable, and the company looks cheaply valued at today's prices. Valued at less than 13 times this year's expected earnings, the stock offers attractive upside potential for long-term investors. While the company's caught on transactions has been pressured, the business is still serving solid results. Total transaction volume rose 11% year over year to hit $76.5 billion in this second quarter, helping to push sales in the period up 7% to $7.3 billion. Meanwhile, sales growth and cost-cutting initiatives pushed non-GAAP net income up 20% to reach $1.6 billion. The market is still poised for a big growth over the long term. The industry is big enough to support multiple successful players. PayPal is well positioned to ride out challenges posed by some shifts in the competitive landscape. Thanks to its massive user base and existing tech infrastructure, the company also has advantages when it comes to launching a new service on top of its existing foundations. Okay, NVIDIA is best known as the pioneer of the graphics processing unit that generate realistic images in video games. However, researchers discovered that the sheer number of crushing a capacity that made the possible cloud also be used to move vast amounts of data at lightning speeds through data centers and cloud computing platforms, making them a natural fit for training and running AI systems. The company's recent results highlight the unprecedented demand. In its fiscal 2024 second quarter, Nvidia generated record revenue of $13.5 billion, an increase of 101 uh, percent year over year, while earnings per share of $2.48 climbed 854%. Blah blah blah. Okay, it's getting too late. I'm gonna see you tomorrow and happy Tuesday night. Okay, see you and bye bye. Bye bye.